Let me ask you something real quick. If you woke up tomorrow and found out you lost $21 billion, would you even finish your coffee? Or would you just stare at the cup like it personally betrayed you? Because that's exactly what happened to Larry Ellison. In the first 20 days of 2026, the founder of Oracle didn't just have a rough patch in the stock market. He watched $21 billion disappear from his net worth. That is more money than some entire countries produce in a year. Gone. No alarm. No warning label. And today, we're not here to admire success. We're here to perform a wealth autopsy to find out what actually killed $21 billion. And, more importantly, why this matters to every artificial intelligence investor in 2026. Most videos about billionaires do the same thing. They show you how smart they were, how early they invested, how everything magically went right. Cool stories. But honestly, you learn way more by studying what went wrong. Because Larry Ellison didn't lose money by being reckless. He didn't gamble it away. He didn't forget his password. He lost $21 billion by making 3 math mistakes that looked perfectly reasonable at the time. Mistakes that professional investors made, Wall Street analysts missed, and millions of artificial intelligence investors are still making right now. This is not a point-and-laugh story. This is a warning label disguised as a billionaire. Before we get into the damage, we need to understand who Larry Ellison really is. This is not some random executive. Larry Ellison co-founded Oracle, one of the most powerful software companies on Earth, helped build the backbone of how banks, governments, and corporations store data, turned databases into an empire. For decades, Oracle was boring, but incredibly profitable. Slow growth, massive cash flow, rock-solid confidence. Larry Ellison wasn't chasing trends until artificial intelligence entered the chat. And that's where the story takes a very sharp turn. Around the world, one phrase started controlling the stock market: artificial intelligence. Every company wanted in, every investor wanted exposure, and every stock that even whispered artificial intelligence saw money rush in. Oracle wasn't supposed to be exciting, but suddenly it had something special. It already owned massive data infrastructure, enterprise customers, cloud systems that could power artificial intelligence workloads. So the story became simple. If artificial intelligence needs data and Oracle owns the data pipes, Oracle must be a winner. The stock didn't just rise, it repriced itself. And that's where the first mistake quietly began. Here's the trap. Oracle was growing, but the market didn't care about growth anymore. It cared about growth speed. Investors stopped asking, how much money does Oracle make? And started asking, how fast can this number accelerate because of artificial intelligence? Oracle was suddenly valued like a company that would rapidly dominate artificial intelligence infrastructure, take market share at extreme speed, scale faster than its own history ever showed. That expectation got baked into the stock price. So even when Oracle delivered good results, they were no longer good enough. Here's the brutal rule of markets. Stocks don't fall because companies fail. They fall because expectations were too high. Oracle didn't collapse. Its business didn't break. But the story investors told themselves was more aggressive than reality. So when reality showed up, even slightly slower, the stock corrected. And because Larry Ellison's wealth is deeply tied to Oracle stock, every small percentage drop translated into billions disappearing from his net worth. And this was only the beginning. Alright, things get really interesting here. Let's talk about valuation, the least exciting word that causes the most damage. During the artificial intelligence boom, Oracle wasn't valued like Oracle anymore. It was valued like a future artificial intelligence superstar. Investors started paying today for profits that might exist years from now. That's fine, if those profits arrive on schedule. But here's the illusion. A stock can look strong while becoming incredibly fragile. Because when valuation stretches too far ahead of reality, even good news can feel like bad news. Think of Oracle's stock like an elastic band. The further you stretch it away from fundamentals, the more tension you create. Oracle's valuation assumed faster artificial intelligence adoption, bigger cloud market share, immediate payoff from massive investments. But reality moves slower than hype. So when growth didn't snap forward fast enough, the stock didn't crash, it reverted. That snapback erased billions in market value. And for Larry Ellison, that snapback hit personally. Here's something most people don't realize. Billionaires usually don't lose money in dramatic explosions. No headlines screaming bankruptcy, no sudden zero. They lose money quietly. A few percentage points here, another dip there, but when your wealth is concentrated in one stock, a 5% move is not 5%. It's billions. Larry Ellison didn't wake up poor. He just woke up $21 billion lighter, and there was still one more mistake left. Here's the third mistake, and this one is sneaky. Larry Ellison's wealth is heavily concentrated, not diversified across dozens of companies, not spread evenly across industries. A massive portion of it lives in Oracle stock. That works beautifully on the way up. But concentration has a dark side. When one company sneezes, your entire net worth catches a cold. Even a normal correction in Oracle's stock became a personal financial earthquake. Now add one more layer of danger. The artificial intelligence echo chamber. Everyone was telling the same story. Artificial intelligence will change everything. Artificial intelligence will grow forever. Artificial intelligence winners will only go up. When everyone agrees on the same future, the price already reflects that future. So when Oracle's artificial intelligence progress was good, but not miraculous, the market adjusted expectations. That adjustment didn't care who owned the shares. Let's be clear, this was not a failure story. Oracle is still profitable, still powerful, still relevant. Larry Ellison is still a billionaire many times over. This was a valuation reset, not a business collapse. But valuation resets are brutal when expectations get ahead of reality. And that's the lesson most investors ignore. This story is not really about Larry Ellison, it's about you. Because most artificial intelligence investors believe the same dangerous idea. If the future is guaranteed, the price doesn't matter. But the stock market doesn't reward correct predictions. It rewards correct pricing. You can be right about artificial intelligence changing the world and still lose money if you overpay for that future. Larry Ellison didn't misjudge technology. The market misjudged timing. This is one of the hardest truths in investing. A company can be well-run, profitable, essential to the future, and still be a bad investment at the wrong price. Oracle didn't suddenly become worse. The expectations placed on Oracle became unrealistic. That gap between expectations and reality is where money disappears, even for billionaires. So what actually killed $21 billion? Not failure, not bad leadership, not broken technology. It was 1. Expectations growing faster than reality. 2. Valuation stretching too far into the future. 3. Wealth concentrated in one unstoppable-looking story. 3 simple math errors, wrapped in a very convincing narrative. If you take one thing from this story, make it this. In 2026, the most dangerous words in investing are, "This time is different. Artificial intelligence is real. The impact is real. But the pricing risk is also real." When everyone believes a future is guaranteed, the downside risk quietly grows. That's exactly what happened here. Here's a simple test you can use. Before you invest, ask, am I buying numbers or a story? Am I paying for growth or paying for hope? Even billionaires fail this test when narratives get loud enough. Larry Ellison just passed it the hard way. $21 billion disappearing doesn't hurt Larry Ellison's lifestyle, but it reveals something important. If this can happen to someone with decades of experience, data, and power, it can happen to any investor who ignores valuation and concentration risk. So if you woke up tomorrow and saw billions disappear, the real question wouldn't be, what went wrong? It would be, did I confuse the future with the price? That single mistake is responsible for more lost wealth than almost any market crash. Next time you hear someone say, this artificial intelligence stock can only go up, remember this story. Because $21 billion didn't vanish by accident. It vanished by math. And in 2026, math always wins.